would like, if I may, to take you on a strange journey.
Hello, everyone, and welcome to another edition of Real Estate Realities with the Rebel Broker. My name's Robert Whitelaw, and I am the Rebel Broker. Licensed real estate broker in the state of California, member of the National Association of Realtors. But please, don't hold that against me. Welcome to the end of the week. I hope it has been a productive one for everyone. Here in California, we're finally getting all of that rain that everyone's been wishing for the last few years. And for whatever reason, that has played havoc again with the power at my house. So apologies for no show on Thursday. We've got a couple of interesting ones today, folks. A revisit on the FHA mortgage insurance premium cut that we talked about a little while back. We've got an interesting take on student debt that is actually a little bit concerning, because remember, one of the things we like to do here is track overall indebtedness and then how much default there is in that indebtedness, because those are the kinds of things that let you know might be a warning sign of bad things to come when you start to see the indebtedness not just increase, but then see the default rate increase. So we're going to talk about that a little bit too. And we'll also talk yet again about how contradictory things can be. In the tool that I use to sift through all the thousands of things that get published relating to real estate, frequently I'll come against something where literally one line apart from each other, two different headlines will make the exact opposite claims about a piece of news, which just should reinforce to everyone how important it is to not just read the headlines. And of course, while that's true in the world of real estate, it's true in everything. It seems like everything is is working to get packaged in some way for you to form an opinion in one direction or another. And a lot of that gets just shoved right into a headline, because I guess most of these folks realize the vast majority of us aren't going to read those articles. And then those of us who do read might just read that first paragraph and never get down to that fifth paragraph where everything they said before it suddenly gets turned on its head. So we'll cover that too. Got a few interesting things. Well, actually, I had a lot to choose from today in terms of cool stuff to talk about. So hopefully we'll be ending the week on a high note here. You can maybe use this stuff in conversation over the weekend, or use it to fuel your own real estate endeavors, whatever they may be. Of course, the best way to reach out and get in contact with me is to head on over to the website at therebelbroker.com. From there, you can enter to win a $50 Amazon gift card by clicking the button at the top of the page. It's a big red sucker, so you're not going to miss it. It says, take the survey to support the show. You'll be asked for an email address 2 different times. Use the same email address both times. Then answer a handful of questions. You'll not only be helping the show grow, but you'll also be putting yourself in the running for a $50 gift card. We've already handed out $200 so far. And congratulations to those folks, and good luck to those of you who have yet to enter. And we'll see you at the beginning of February when we pull another lucky winner for that $50 gift card. And of course, you can also join in the Rebel Underground, which is going to be getting exclusive content. It's going to get its first piece of exclusive content within the next week. I'm kind of excited about that. I'm finding different ways to make joining the Rebel Underground more compelling for folks, and this is just one way to do it, but there's going to be plenty more. To join the Rebel Underground, you can simply text the word Rebel Broker to the number 44222. That's the word Rebel Broker, all one word, to the number 44222. You can also go to therebelbroker.com, and after about 40 seconds of being there, a dialogue will pop up asking you to provide some information, and then that will also put you into the Rebel Underground. All right. So where shall we begin? Shall we start with the most sexy thing? No, let's go ahead and start with this one. As we mentioned a few shows back, the FHA mortgage insurance premium was getting cut. And this was something I thought was not a good thing. In fact, if you go back and you do a search on that particular topic over the last few weeks, you'll see I specifically described it as a bad thing. Simply because the purpose that it serves is to be a safety net in the case where someone defaults on their FHA loan. And remember, when we're talking about FHA loans, we're talking about folks who only have 3.5% skin in the game. So that means if they bought a $100,000 house, they only had to come up with $3,500 to get that house. So in some marketplaces, now we're in an increasing market in a lot of areas right now. So after a year, hopefully it's grown by a few percentage points. Great. Then they're more vested in the property. But what that really means is all we need to do is get a 4% drop in the price of their home, and they are underwater. The home is now worth less. Now, that's the most optimistic math, because let's figure this out for a second. And I've had plenty of people reach out to me and want to quibble one way or another on whether or not this is a good thing or a bad thing. Despite all those conversations, I continue to believe it's a bad thing. But think about it for a second. If you're going to sell your home, the costs involved would make it so that the second escrow closes, you're underwater. Even after price appreciates a couple of percentage points, you're underwater. So I think those are things that are profoundly important to keep in mind. So since if you're going to try to sell that home, odds are you're going to list it for sale, right? Well, you're definitely not going to list it with an agent for less than 4.5%. Best case scenario, 5%. And that would be an agent who's very discounted. It would be anywhere from 4.5% to 6%. This doesn't include closing costs. It doesn't include title insurance, which in my state in my area by custom you tend to pay, even if you split it. I mean, these are all things that are going to add up, right? We're talking about thousands and thousands and thousands of dollars, most of them based on percentages. So, for instance, if you're guesstimating closing costs in my area, I usually like to use the number 1.2 to 1.3%. Add on commissions, and that probably gets us anywhere from 5.5% to 7.5%, based on whatever deal you manage to put together. So that whole amount you need to make up, you need to increase your equity in that home by 3.5% above your purchase price in order for things to start to make more sense, at the very least. And really, it's more like 6%, 7%. You need to increase it. So all in all, we are selling homes to people who, from the moment they close escrow, they are underwater, even with the way the market exists today. And really, the only hope is that over that first couple of years, that enough growth happens in that marketplace that that number tightens up, that they end up not owing more than the home is worth. Now, timing, of course, is everything. But if you've just purchased a home with FHA and then there's a downturn in the marketplace, what do you do with that? I guess it depends. Where's the sweet spot? But the point is, that's another discussion. We've had that discussion. But the point here is the monies that are spent for this insurance is specifically designed to insulate the rest of us from these defaults. And we all saw what happens when those defaults occur. And we didn't have enough money last time. And we increased those rates to more responsibly cover the potential downside of these risky loans. These are risky loans. Bottom line. So my argument was you weren't doing anyone any favors by reducing these costs. Even the folks you think you're specifically helping, the buyer, is not being helped. You are immediately saddling them with debt that represents more than what the home is worth. So you're already hosing them right at the get-go. You're encumbering them with an amount we already know is a risky amount for them, because that's the nature of the loan. That's who a lot of these loans are aimed at. And all the way down the road, every single individual who's involved, all the way out to the taxpayer who ends up left holding the bag when things go wrong. Because remember, the last time things went wrong, after several hundreds of billions of dollars of funds allocated to dealing with that downturn, they ultimately, because they were looking so stupid every single time they had to pass another bill to fund dealing with this problem, they finally wrote one up that just said, whatever amount of money it takes, we're authorized to give to the government sponsored entities, the Fannie, Freddie, FHA, all that stuff, to cover all of that debt, to cover the losses from this, we just authorize whatever amount. Now, I don't know about you, but if you're a parent and you send your kid out to get the car fixed, you don't tell them you're approved to get repairs authorized to whatever amount it comes to, right? You're typically going to want to at least have a limit put on that. But we didn't, because too many of the politicians that got us into this mess were tired of having to continuously throw more money at it through the process and decided they want to do it the other way. So anyway, why are we talking about this again? Well, according to this article, Trump is planning to repeal the FHA mortgage insurance premium cut. And the question is, will it be a delay or an indefinite delay? According to the article, and this comes to us from Housing Wire, when Ben Carson, President-elect Donald Trump's choice to lead the Department of Housing and Urban Affairs, appeared last week before the Senate Committee on Banking, Housing, and Urban Affairs, one of the topics of discussion was the outgoing administration's recent decision to cut Federal Housing Administration mortgage insurance premiums on its way out the door. At the time, Carson said that the Trump administration plans to really examine the Obama administration's decision to cut FHA premiums before determining a course of action. Now, I watched that particular exchange, and it seemed like a very soft response, which kind of led me to believe that the decision to eliminate these premiums might not be something to expect, just because it wasn't. And I don't know, maybe this answer was simply meant to be vague because they hadn't really thought about it. But with the inauguration not that far away, it appears that the Trump administration will do more than just examine the FHA premium cut once Trump is sworn in. According to multiple sources, the FHA premium cut, which is currently scheduled to go into effect on January 27th, will be delayed at the very least by the incoming Trump administration. One source told Housing Wire that repealing the FHA premium cut is on the list of things that the Trump administration plans to review and or roll back almost immediately. The source also told Housing Wire that the Trump administration will not enact the premium cut on the 27th while it considers the impact of the premium cut on the FHA's mutual mortgage insurance fund before determining whether to proceed with the cut. And they also mentioned that it's a distinct possibility that the premium cut will be eliminated entirely. The Trump transition team told Politico's Lorraine Wohlert on Wednesday that it is yet to make an official decision on the FHA premium cut, but a statement given to Wohlert by a Trump spokesperson shed some light on the incoming administration's view of the outgoing administration's move. So let me just give you that quote. Quote, "The incoming policy team has not seen the model the outgoing administration used, nor their analysis, and nothing was communicated to the incoming team before the announcement was made. The new team looks forward to seeing the financials to ensure there is the right balance between encouraging sustainable home ownership at an individual level and protecting taxpayers against future losses to the entire program. No determination has been made on this last-minute policy change by Secretary Castro that could detrimentally impact FHA's reserves." Totally rational response. I think that makes a whole lot of sense. And it's one of those things where it may feel better to feel like you're doing something for someone. And I get that. I understand that feel-good thing. But for me, when you think just a couple of layers down, you're potentially hurting somebody a whole lot more than you're helping them. And in addition to potentially hurting the exact person you're thinking to help, you're also hurting everyone else down the line. So I honestly don't see an upside here. And I think that you could make the argument that the premiums as they are, or even as they were, because remember, this would be the second cut in the premiums. I actually think that the premiums make sense being a little bit higher than they are. Because after living through what we've all lived through, I don't think anyone can make the argument, well, it just won't happen, or if it does happen, it'll be extremely limited. The idea of not having an appropriate amount of money as a backstop to this is just ludicrous, particularly with what the lessons we should all still have very firmly implanted in the front of our brain. Okay. So we're going to go ahead and cover another topic here in a second that I think is concerning relating to debt and will absolutely play into who are likely to be strong buyers in the future. We'll cover that in just a second, so don't go away. We'll be right back.
Are you ready to jump in and start your search for your first investment property? Maybe you've decided that it's time to own your own home, or maybe you're ready to sell your home and move on to something new. No matter what your goal is, the Rebel Broker can help. That's right, aside from hosting this show, I am also the owner broker of Whitelaw & Sons Real Estate Services right here in Silicon Valley. With over 25 years experience serving Silicon Valley, Morgan Hill, San Martin, and Gilroy, I or one of my great agents can help you achieve your goals in real estate. So if you're ready to look into taking that next step towards achieving your real estate goals, point your browser at www.soldbyrobert.com. That's www.soldbyrobert.com and get in touch. Let me show you how I will earn your business and your respect. Again, that's www.soldbyrobert.com, or you can call me at 408-852-0525. California Bureau of Real Estate ID 00984-909.
Welcome back, everyone. We just had a quick chat relating to an update on the FHA plan to reduce the mortgage insurance for their borrowers, and that it's looking like the Trump administration is at least going to delay that policy implementation. It was supposed to happen on the 27th. Now it's likely to get delayed, if not canceled entirely. I actually think that makes some good sense. So we'll see how that plays out. An interesting note that came out Thursday, so yesterday, from the folks over at Zero Hedge. And this is a subject that they've been covering for a while, or at least talking about for a while, that I never really pushed because a lot of it was just, it sounded like a lot of it was their opinion. However, it's turned out that they are apparently correct. They finally got confirmation yesterday, Thursday, that, as speculated by them previously, the U.S. government was indeed fabricating student loan default data, making it appear far lower than it was in reality. The Wall Street Journal reported overnight that, quote, many more students have defaulted on or failed to pay back their college loans than the U.S. government previously believed. Now, of course, in order for you to really figure out what you think about this subject, I will put a link to not only the Zero Hedge article, but also to the Wall Street Journal article. You just want to be aware that I believe the Wall Street Journal article may be behind a firewall. I happen to, or a paywall. I happen to pay for the Wall Street Journal, so I was able to get immediate access to it. But just a heads up that you may have to look for other venues to get that information. And according to that article, their subheadline is Revised Education Department Numbers shows that more than 1,000 schools, at least half of students, that's a huge number, at least half of students defaulted or failed to pay down debt within 7 years. And that is nuts for a couple of reasons. One, students on student loans don't start paying down debt until I think it's 1 year after they graduate. So we're not talking about this being now. We're not talking about this affecting future graduates. We're talking about this affecting people who graduated 7 or 8 years ago. We're talking about people in their late 20s. We're talking about those millennials that we are expecting to jump in and become these big buyers. And this is just one reason to expect that may not happen. If we're seeing this, where 50% of the folks aren't servicing this debt, that is absolutely going to have a dramatic effect on these folks' ability to purchase. Let's see. The new analysis shows that at more than 1,000 colleges and trade schools, or about a quarter of the total, at least half the students had defaulted or failed to pay down at least $1, at least $1 on their debt within 7 years. The changes could have implications for federal policy. Some lawmakers have endorsed the idea of punishing colleges if enough students aren't paying back the loans. I'm not sure why you'd punish colleges, with the person who's not paying the loan back being the problem. A spokeswoman for the education department said that the problem resulted from a technical programming error. This isn't the first time data problems have affected the education department. A recent governor report criticized how the department tracks information, including the budgetary implications of student loan forgiveness. And so what's amazing about this, right, is they use this same system for budget projection implications when they forgive loans, and they've been underestimating the amount that's been out there. So we not only have a situation where half the students aren't paying their loans over the course of 7 years by even $1, we have a system, an education department at the federal level that has been basing all of their plans, all the things they've been doing, all their expectations based on wrong data. How might that affect the whole situation? Quote, this is a quality control issue with a Department of Education that has been facing criticism already for other data issues. Robert Kelchin, an assistant professor of higher education at Seton Hall University. The department, quote, needs to be regularly audited so those issues can be discovered sooner. The student loan repayment rates were originally released in 2015 as part of the Obama administration's college scorecard, which followed an aborted attempt to rate colleges and tie federal funds to those ratings. In September, the department released data tracking students who should have begun repayment in 2007 and 2008, and that number rose to 477. But with the updated number released last week, that number grew to 1,029. No college saw its repayment rate improve under the revision, and some schools saw their 7-year repayment rates fall by as much as 29 percentage points. So, and that's some of the insights from the Wall Street Journal. The data revealed that the department previously had inflated the repayment rates for 99.8% of all colleges and trade schools in the country. At least half the students had defaulted or failed to pay down at least $1 on their indebtedness. Some of this we already talked about. The worst offender was the University of Memphis, which had one of the largest drops in its repayment rate following the recalculation. Previously, the department said that 67% of its students were repaying loans within 7 years of entering the repayment period. That number fell to 47% after the recalculation. I'm absolutely going to include a link to this article. I'll also put a Pinterest pin on this interesting graph, which shows you the dramatic change in projection. And I can't imagine this not rippling through everything. Remember, credit affects all kinds of stuff. It affects real estate. It affects your ability to buy a car. Anything relating to your credit is going to be affected by this, the amount of indebtedness, right? And these are all based on projections from the educational system. And now we're seeing that this is a much bigger problem. Everyone who is making plans for what to expect in future markets was basing it off of data like this. And now to find that this data is so far off the mark, the idea of really jumping in and expecting a huge increase in the marketplace based on this buying group, folks in this age group, in terms of folks who've graduated from college and are probably age, 25 to 32? Maybe that would be it. And that's one of the primo ranges, right, that we currently hear people talking about. So absolutely potentially going to change the nature of what we see in terms of the makeup of the next big boom of buyers. And it's looking more and more like this is going to eat away at what everyone expected to be a big millennial show up in the marketplace type dynamic happening here in 2017. Now, what's interesting is this tends to reinforce what I've been suggesting here. I still, just because of my practical experience on the ground, and in terms of just the feel of what was going on with different segments of the market, I didn't feel like we could expect a huge outpouring of millennial activity in the buyer's market. I'd love to say because I guessed this. But I didn't. It was other things that had me thinking that way. But this actually serves as another piece of at least another data point for us to look at in terms of who's likely to be out there as an active buyer. So something to be aware of, particularly if you're flipping, getting a feel for understanding who are the buyers, what are the age groups of the buyers in the areas where you're doing your investing, because it may end up that you can expect less action coming from this age group, and which may also reflect another level of wisdom in doing that flip, doing that remodel, that rehab that you're going to do on that property in a way that falls in line with what we talked about last week in terms of doing upgrades that are going to appeal to as broad an age spectrum as possible, because you may not be able to rely on that bubble of millennials that, again, everyone has been saying is going to happen over the next year. So I think that's kind of an interesting one to just put in the back of your head and let germinate there for a while and see if it doesn't affect how you might move forward with your investments. So let's go ahead and wrap up today's show with one last bit of data that I think is kind of interesting. And of course, I'll include links to these articles in the show notes if you'd like to visit them over at therebelbroker.com. We've got a couple here, little bit contradictory. We had two articles that came out indicating that Homebuilder Confidence pulls back by 2 points in January after election euphoria. The other headline was Builder Confidence decreased to 67 in January. And if I'm not, there was actually one other article, and I can't find it now, that actually tried to give the impression that builder confidence was up in January. It is in fact down. But here's an interesting one to be aware of. While that may be true, architectural billings index increased in December. So the American Institute of Architects reported the December ABI, or Architectural Billing Index. Score was 55.9, up sharply from 50.6 in the previous month. So if you want the leading indicator of future stuff in terms of construction, this is one of them, because one of the first things they start doing is drawing up the plans, right? They'll usually, oftentimes there will be at the same time acquisitions of the property or some other types of things, but increases in December, and increases in this number in the Architectural Billings Index is a good indicator of future stuff. So while we do see builder confidence reducing a little bit, remember we've talked about this, you always want to look at the actual actions of what's going on. Now, it surprises me that given we've seen increased billings to architects, that we've seen a decrease in confidence, because normally what we've been seeing is a increase in confidence, but then all the other ways that you would measure that confidence being actually put into effect, like increased permits, more started jobs, more architectural billing, those things have all indicated less confidence. Now we're seeing the opposite. We're seeing a slight decrease in confidence, but we're seeing an increase in the amount of money that's being spent by architects. To sort of break it up into areas, regional averages in the Midwest, it was 54.4, the Northeast 54.0, in the South 53.8, and in the West 48.8. I think that's actually kind of interesting that the lowest number is the West. So that kind of indicates we're seeing less projects going down or happening in the West, which is, for us, we need it. We need it pretty bad. Now, in terms of sector, commercial industrial is at 54.3, institutional 53.3, mixed practice 51.9, and multifamily residential 50.6. So that's a concern as well, to see that the multifamily residential number is the lowest number of the bunch. So that may be what explains a correlation between maybe a little bit of lack of confidence on the part of the builders and on the part of architects seeing more work, because they're tending to maybe see this work happening in areas that are not residential. But I wanted to give you that. I think it's interesting to note those kinds of things, particularly with the home builder confidence numbers. The sentiment index retreated 2 points in January, and December's 7-point jump was revised down by 1. The National Association of Home Builders Wells Fargo Housing Market Index now stands at 67. 50 is the line between positive and negative sentiment. The index was at 61 in January of 2016. So it's a month-to-month change, but in terms of confidence compared to the same time last year, it's actually higher. It's actually 6 points higher. So short-term, less confident. Long-term, more confident. We'll see how that affects actual works. The next number I'm going to want to be looking for is actual work started. Once we move past permits into folks actually sticking a shovel in the ground to start construction, that's going to be the next interesting tidbit. Now remember, as we've talked about in previous shows, the projection of the experts was we'd start to see the inventory growing to the point where it will put a dent in demand in 2020. Now that's only 3 years away. So we've got a long way to go before this inventory situation supposedly gets addressed. But I think one thing we're seeing is the building world trying to not overbuild. They absolutely do not want to recreate that situation that we had in 2005, 2006, when there was this enormous bubble of building that ended up pretty much putting too many properties into a mix where demand suddenly dipped because of the financial downturn that we had. But we're listening to see how this evolves, and of course, I'll keep you up to date. All right, folks. As always, I am hoping that the time you spend listening to the show is repaid with some fabulous data, information, and insights that can help you have great discussions with other folks about real estate, or just stuff you find interesting, or maybe even help you move forward with your real estate goals. Thanks again for listening. I'll talk to you all next time.